Let me ask you something simple. Imagine you have $100 sitting in your pocket right now. You could spend it tonight. You could buy dinner, maybe a new book, or just let it sit in your bank account, doing absolutely nothing. And in 10 years, that same $100 will still be $100. Maybe less because of something called inflation, but we will get to that. Now imagine a different path. What if you put that $100 to work today? What if instead of letting it sit there, you let it grow, quietly and steadily, while you sleep, while you work, while you live your life? That is the core idea behind investing. And today, we're going to break it all down from the very beginning. No complicated financial jargon, no assumptions that you already know what a stock is or what a bond does. Just a clear, honest conversation about what investing actually is, why it matters, how it works, and how you, yes, you, can start thinking about it no matter where you are in life right now. Whether you are a complete beginner who has never thought about money beyond paying bills, or someone who has heard the word investing 1,000 times but never really understood what people mean, this video is for you. So grab a drink, get comfortable, and let us talk about one of the most powerful things you can do for your financial future. All right, let us start with the most basic question of all. What exactly is investing? If you look it up in a financial textbook, you might find something like this. Investing is the process of allocating resources, usually money, with the expectation of generating an income or profit over time. Okay, that sounds fine, but let us make it more human. Investing is simply putting your money somewhere today so that it can grow into more money tomorrow. Think about it like planting a seed. You put a tiny seed into the ground, you water it, you give it sunlight, you are patient, and over time that seed becomes a tree. That tree then produces fruit, and that fruit keeps coming, season after season, year after year, as long as the tree is healthy. Your money works the same way when you invest it. You plant it somewhere smart, you give it time, and it grows. Now compare that to saving. A lot of people use the words saving and investing interchangeably, but they are actually very different things. Saving is putting your money somewhere safe, usually in a bank account, where it does not go anywhere and does not grow much. The main goal of saving is security. You want that money to be there when you need it. That is totally valid, and saving is important. But here's the thing most people do not think about. Inflation eats your savings alive. What does that mean? Inflation is the gradual rise in the price of things over time. A cup of coffee that cost $2 10 years ago might cost $4 today. The money you had did not grow, but everything costs more. So in a very real sense, your money has less purchasing power than it did before. It can buy less stuff. In Europe and America, inflation has historically averaged around 2 to 3% per year, and most standard savings accounts offer much less than that in interest. So if inflation is running at 3% and your savings account is giving you 0.5% interest, you are actually losing purchasing power every single year. Investing is how you fight back against inflation. It's how your money grows faster than the cost of living rises. And that's why it matters so much. Okay, so now you know what investing is, but why do people actually do it? What are they trying to achieve? Here's the thing. People invest for all kinds of reasons, and those reasons are usually deeply personal. Let us walk through a few of the most common ones. Building wealth over time. The first and most obvious reason people invest is to build wealth, to have more money tomorrow than they have today. And this is not just about becoming rich in the flashy, Instagram-worthy sense of the word. It's about creating financial stability, about giving yourself options, about being able to say yes to things that matter and no to things that do not. When you invest consistently over many years, something magical happens. Your money starts making its own money, and then that money makes more money. This is called compound growth, and we're going to talk about it in detail a little later because honestly, understanding compound growth might be the single most important thing you can take away from this video. Retirement. Another huge reason people invest is for retirement. At some point, most of us want to stop working, or at least stop having to work. And when that day comes, you need money to live on. Gone are the days when you could rely entirely on a government pension or a company pension. In many parts of Europe and the United States, pension systems are under strain. The state pension in the UK, for example, provides a foundation, but for most people it's not enough to live comfortably on its own. Same story in the US with Social Security. If you want to retire on your own terms, you need your own money, and the best way to build that money over decades is through investing. Achieving big financial goals. Investing is also how people reach big goals. Buying a home, starting a business, paying for their children's education, funding a dream trip. These are expensive things, and if you're simply saving money in a bank account, it might take much, much longer to get there. With investing, your money works harder and those goals become reachable faster. Beating inflation. We already touched on this, but it's worth repeating because it's so important. Investing is how you make sure your money does not slowly die. The purchasing power of cash erodes over time. Investing is the antidote. Generating passive income. Some people invest specifically to generate income without having to actively work for it. Dividends from stocks, interest from bonds, rent from property, these are all forms of passive income that certain types of investments can produce. Imagine getting a payment every month or every quarter simply because you own something. That's the power of income investing. The bottom line is this: whether your reason is retirement, a house, financial freedom, or just wanting to have more money than you do right now, investing is one of the most powerful tools available to help you get there.
All right, let us talk about something that Albert Einstein is said to have called the eighth wonder of the world: compound growth. Now, whether Einstein actually said that or not, the sentiment is absolutely right. Compound growth is genuinely one of the most astonishing things in all of personal finance. And once you understand it, you will never think about money the same way again. Here's how it works. Let us say you invest $1,000 today, and it earns 10% in 1 year. Great, you now have $1,100. Easy enough. But now here's where it gets interesting. In the second year, you earn 10% not just on your original $1,000, but on the $1,100. So you earn $110, not just $100, and you now have $1,210. In the third year, you earn 10% on $1,210, and so on. Every single year, the amount you earn gets a little bigger because the base you're earning on keeps growing. This does not sound like much at first, but give it time and the numbers become extraordinary. Let us look at a real example. If you invest $10,000 at an average annual return of 7% and you never touch it, here's what happens. After 10 years, you have about $19,600, nearly double. After 20 years, you have $38,600. After 30 years, you have $76,100. And after 40 years, you have $149,700, almost 15 times your original investment. You did not add a single extra dollar. You just let it sit and grow. That is the power of compound growth over time. Now, imagine if you kept adding money regularly. Most financial advisors recommend investing a fixed amount every month, a strategy called dollar cost averaging, which we'll talk about shortly. If you invest $500 a month at that same 7% return, after 30 years, you would have over $560,000, $500,000 built from monthly contributions that most working people can realistically manage. The most important ingredient in all of this is time. The earlier you start, the more time your money has to compound. A 25-year-old who starts investing will end up with dramatically more money at retirement than a 40-year-old who invests the same amount. Not a little more, a dramatically larger amount, because of those extra 15 years of compounding. This is why financial advisors always say the best time to start investing was yesterday. The second best time is today. Do not wait. Time is the one ingredient you can never buy back. Now let us get into the actual types of investments. Because when people say they want to invest, what exactly can they invest in? There are many different asset classes, which is just a fancy way of saying categories of things you can own as investments. Each one has its own characteristics, its own risks, and its own potential rewards. Let us go through the most important ones. Stocks. Stocks, also called shares or equities, are probably the most well-known type of investment.
When you buy a stock, you are buying a small piece of ownership in a company. If that company does well, your stock becomes more valuable and you make money. If it does poorly, your stock loses value and you lose money. For example, if you had bought shares in Apple or Amazon back in the early 2000s and held onto them, you would have made extraordinary amounts of money. But of course, not every company grows like Apple or Amazon. Some companies fail. Some stocks crash. Historically, stock markets have produced average annual returns of around 7 to 10% over long periods of time, which is why they're such a popular investment vehicle. But they come with volatility, meaning the value can go up and down significantly in the short term. In any given year, the market might rise 20% or fall 30%. This is why stocks are generally better suited for long-term investing. If you have 10, 20, or 30 years before you need the money, you have time to ride out the ups and downs and benefit from the long-term upward trend. Bonds. Bonds are quite different from stocks. When you buy a bond, you're essentially lending money to a company or a government. In return, they promise to pay you back after a set period of time, plus interest payments along the way. Think of it like this. If your friend borrowed $500 from you and promised to pay you back in 5 years with 5% interest per year, that's essentially how a bond works. Bonds are generally considered safer than stocks because you know exactly what you're going to get back. But because they're safer, they also tend to produce lower returns. Government bonds from stable countries like Germany or the United States are seen as extremely safe investments. Corporate bonds can offer higher returns, but carry more risk. Many investors hold a mix of stocks and bonds to balance risk and reward. The older you get and the closer you are to needing your money, the more bonds you might hold compared to stocks. Index funds and ETFs. Now here's where things get really interesting for most beginner investors. Index funds and exchange-traded funds, commonly known as ETFs, have revolutionized the way ordinary people invest. Instead of trying to pick individual stocks or bonds, which requires a lot of knowledge and carries higher risk, index funds and ETFs let you invest in a huge basket of stocks or bonds all at once. For example, an S&P 500 index fund, which is one of the most popular in the world, invests in the 500 largest companies in America all at once. Apple, Microsoft, Amazon, Google, all of them in one single investment. If the overall market goes up, your investment goes up. If it goes down, it goes down. But because you're spread across hundreds of companies, you're not wiped out if any one of them fails. This concept is called diversification. Do not put all your eggs in one basket. And index funds and ETFs make diversification incredibly easy and affordable. They also tend to have very low fees, which matters enormously over time because every dollar you pay in fees is a dollar that's not compounding for you. Many of the world's greatest investors, including Warren Buffett himself, recommend simple, low-cost index funds as the best investment for most ordinary people, and the evidence strongly supports that view.
Real estate. Real estate is one of the oldest and most intuitive forms of investing. You buy a property, its value goes up over time, and you can also earn rental income from tenants. Property has made many people very wealthy over the decades. However, real estate comes with its own challenges. It requires a large upfront investment. It is not easy to buy or sell quickly. You have to deal with maintenance, tenants, taxes, and regulation, and property values do not always go up. We saw dramatic property price crashes in many parts of America and Europe during the 2008 financial crisis. For many people, their home is their biggest investment. But owning your home and investing in real estate are slightly different things. Dedicated real estate investing, whether through buy-to-let properties or real estate investment trusts known as REITs, can be a powerful part of a diversified portfolio. Mutual funds. Mutual funds pool money from many investors and use it to buy a diversified mix of stocks, bonds, or other assets.
They are managed by professional fund managers who decide what to buy and sell. This sounds appealing, but mutual funds often come with higher fees than index funds. And the research is fairly clear that most actively managed mutual funds do not outperform simple index funds over the long term. Still, they can be a useful option for some investors who want professional management. Commodities. Commodities are physical goods like gold, silver, oil, wheat, or copper. People invest in commodities either by buying the physical goods or by buying contracts that represent them. Gold, in particular, is often seen as a safe haven investment. When economies are uncertain or currencies are unstable, people tend to buy gold because it holds its value over long periods of time. It does not produce income or grow the way stocks do, but it can preserve wealth and act as a hedge against economic turmoil. Cryptocurrency. We cannot have a conversation about investing today without mentioning cryptocurrency. Bitcoin, Ethereum, and thousands of other digital currencies have captured the imagination of investors around the world. Cryptocurrency is a highly speculative and volatile asset class. Prices can triple in a matter of months and then crash just as fast. Some people have made extraordinary fortunes from crypto. Others have lost everything. If you are considering investing in cryptocurrency, you should only do so with money you can genuinely afford to lose entirely. It should represent a small portion of your overall portfolio if you choose to include it at all. It is not suitable as a foundation for serious long-term financial planning.
Now let us talk about something that every single investor needs to understand deeply: the relationship between risk and return. Here is the golden rule of investing. Higher potential returns always come with higher risk. Lower risk investments always come with lower returns. There is no investment in the world that offers high returns with zero risk. If someone tells you otherwise, run. Think about it this way. If you lend money to the German government, you are almost certainly going to get your money back. Germany is extremely stable and creditworthy. Because of that certainty, Germany does not need to offer you a very high interest rate. You accept a lower return in exchange for that safety. Now imagine lending money to a small startup company that might not even exist in 5 years. That is a much riskier proposition. So, to get you to take that risk, they need to offer you the possibility of a much higher return. That is the trade-off. Different investments sit at different points on the risk-return spectrum. Government bonds are at the low-risk, low-return end. Individual stocks of small companies are at the high-risk, high-potential return end. Index funds sit somewhere in the middle, offering solid long-term returns with diversified risk. What level of risk should you take? That depends on a few things. First, your time horizon. How long before you need this money? If you're investing for 30 years, you can afford to take more risk because you have time to recover from downturns. If you need the money in 2 years, you should be much more conservative. Second, your risk tolerance. This is both financial and emotional. Some people can watch their investments drop 20% and stay completely calm. Others lose sleep over a 5% dip. Know yourself. There is no point having a high-risk portfolio if it's going to cause you anxiety and make you sell at the worst possible moment. Third, your financial situation. If you have emergency savings and no high-interest debt, you can afford to take more risk. If you're living paycheck to paycheck, now might not be the time for aggressive investing. The goal is to find a level of risk that lets you stay invested through the inevitable ups and downs. Because the biggest mistake most investors make is panic selling when markets fall. Staying calm and staying in is almost always the right move.
Okay, you understand what investing is. You know why it matters. You understand the types of investments and the concept of risk. Now the big question. How do you actually start? Here is a step-by-step approach that makes sense for most people, especially beginners in Europe and America. Step 1. Sort out your financial foundation. Before you invest a single dollar or euro, make sure your financial foundations are solid. This means a few things. Do you have an emergency fund? This is 3 to 6 months of living expenses saved in a liquid, accessible account. A savings account, for example. This is not investing. This is insurance. If you lose your job, if your car breaks down, if you have a medical emergency, this fund means you do not have to sell your investments at a bad time or go into debt. Do you have high interest debt? If you have credit card debt charging 15 or 20% interest, pay that off before investing. There is no investment in the world that reliably returns 20% per year. Paying off debt at that rate is the highest guaranteed return you can get. Once you have an emergency fund and your high interest debt is under control, you are ready to invest. Step 2. Define your goals. What are you investing for? Retirement? A house in 10 years? Financial independence? Your answer matters because it shapes how you should invest. A retirement account that will not be touched for 30 years can be invested more aggressively. A house deposit you need in 5 years should be invested more conservatively. Be specific. Instead of just thinking, I want more money, try thinking, I want to have 200,000 euros by the time I'm 55 to supplement my pension. That specificity helps you figure out how much to invest and in what. Step 3. Use tax-advantaged accounts. One of the most powerful things you can do is invest inside accounts that give you tax advantages. In the United States, this means accounts like a 401k, which is an employer-sponsored retirement account, or an IRA, which is an individual retirement account. These accounts allow your investments to grow either tax-deferred or tax-free, depending on the type, which can make a massive difference over decades. If your employer offers a 401k with matching contributions, that's free money. Contribute at least enough to get the full match before doing anything else. In the UK, the equivalent is a stocks and shares ISA, which lets you invest up to £20,000 per year with no tax on gains or income. Many European countries have similar tax-advantaged savings and investment vehicles. Use these accounts. They are one of the most powerful legal advantages available to ordinary investors. Step 4. Choose a brokerage or investment platform. You need an account through which to actually buy your investments. This is called a brokerage account, and there are many to choose from. In the United States, popular options include Fidelity, Vanguard, Charles Schwab, and for younger investors, apps like Robinhood or Betterment. In the UK and Europe, platforms like Vanguard, Hargreaves Lansdown, Trading 212, and DeGiro are widely used. When choosing a platform, look at fees, ease of use, the investment options available, and whether the platform is regulated by the relevant financial authority. In the UK, that's the Financial Conduct Authority. In the US, it's the SEC and FINRA. Step 5. Keep it simple. Here's advice that will serve you well for the rest of your investing life. Keep it simple. You do not need to be picking individual stocks. You do not need to trade in and out of markets. You do not need to follow financial news obsessively every day. For most people, a portfolio of just 2 or 3 low-cost index funds is all they need. A global stock market index fund, maybe a bond fund for stability, and that's it. Set up automatic monthly contributions, reinvest your dividends, review it once a year, and get on with your life. This simple, boring approach actually outperforms the vast majority of professional investors over long periods of time. Boring is beautiful when it comes to long-term investing. Dollar cost averaging. A strategy worth understanding is dollar cost averaging. This simply means investing a fixed amount of money at regular intervals regardless of what the market is doing. So instead of trying to time the market and invest a lump sum at just the right moment, you invest, say, $300 every month on the first of the month. Sometimes you buy when prices are high, sometimes you buy when prices are low. Over time, this averages out and removes the anxiety of trying to guess what the market will do. Dollar cost averaging is especially powerful for beginners because it takes emotion out of the equation and creates a consistent habit. All right, now let us talk about the mistakes, because almost everyone makes them, and knowing about them in advance could save you thousands of dollars or euros. Waiting for the perfect time. The number one mistake beginners make is waiting. Waiting until they have more money, waiting until they understand everything perfectly, waiting until the market settles down, waiting until next year. There will never be a perfect time. The market will always be doing something that makes you nervous. The truth is, time in the market beats timing the market. Every single time. Research consistently shows that investors who try to time the market underperform those who simply stay invested. Start now. Start small if you need to. Even $20 or €20 a month is better than nothing, because what you are really building in those early months and years is the habit of investing. And that habit, combined with compound growth, will change your financial life. Panic selling during market downturns. When the stock market falls, and it will fall, sometimes dramatically, the instinct is to sell, to get out, to stop the pain. This is one of the most costly mistakes an investor can make. Markets go down, they always have, but they have also always historically recovered and gone on to new highs. The investors who got hurt worst during crashes like 2008 or the 2020 COVID crash were the ones who sold near the bottom and then missed the recovery. The investors who did best were the ones who stayed calm, kept contributing, and maybe even bought more while prices were low. This is easy to say and hard to do, but understanding that downturns are a normal, temporary part of investing will help you keep your head when everyone around you is panicking, trying to pick individual stocks. Everyone has a cousin or a colleague who tells them about the hot stock they should buy right now, the one that's going to 10 times in value. And sure, occasionally someone picks right, but for every person who made a fortune picking the right stock, there are thousands who lost money trying. Even professional fund managers with enormous teams of researchers and analysts fail to consistently beat the market. What makes you think you can do it from your phone on a Tuesday night? This is not to say you can never buy individual stocks, but it should be a small speculative portion of your portfolio, not the foundation. Ignoring fees. Fees are the silent killers of investment returns. A fund that charges 2% per year in fees versus one that charges 0.1% might sound like a small difference, but over 30 years, that difference could cost you tens of thousands of dollars or euros. Always check the fees on any investment product. The lower, the better. This is one of the clearest advantages of index funds over actively managed funds. Putting all your eggs in one basket. Concentration risk is real. If you put all your money into one company, one sector, or one country, and that thing does badly, you can lose a massive chunk of your wealth. Diversification is your best friend. Spread your investments across different companies, sectors, and geographies. Index funds do this for you automatically, getting emotionally attached to investments. Sometimes investors fall in love with a particular stock or asset. Maybe it's a company they admire or one that has done well for them in the past. This emotional attachment can lead them to hold on too long when they should sell, or to invest too much in one thing. Investing should be rational, data-driven, unemotional. Treat your portfolio like a business, not a pet. Investing is not one size fits all. Your approach should change depending on where you are in life. Let us walk through different life stages and what investing might look like at each one. In your 20s. Your 20s are honestly one of the best times to start investing. You have the most precious resource of all, time. Even small amounts invested in your 20s can grow into significant wealth by retirement. In your 20s, you can afford to take more risk. Your portfolio can be heavily weighted towards stocks and growth-oriented investments. If the market crashes, you have decades to recover. Focus on building the habit of investing, contributing regularly, and not touching the money. If you can invest even 10 to 15% of your income, you will be miles ahead of most people. In your 30s. Your 30s often bring more financial complexity. Maybe a mortgage, a partner, children, a more established career. Your income is likely higher, but so are your expenses. This is a time to be intentional about your financial goals. Max out your tax-advantaged retirement accounts if you can. If you have not started yet, do not panic. Start now. You still have 25 or 30 years until a typical retirement age, which is plenty of time for compound growth to work. You might also be thinking about other goals, like building a college fund for children or saving for a bigger home. These shorter-term goals might require a more conservative investment approach with a higher proportion of bonds or cash. In your 40s. Your 40s are often peak earning years. You hopefully have more income than ever, and your retirement is close enough that it starts to feel real. Many financial advisors suggest gradually shifting your portfolio to be slightly more conservative as you approach retirement, adding more bonds, reducing some of the higher risk stock exposure. But do not be too conservative too early. You still have 20 or more years of retirement ahead of you, during which your money still needs to grow. Continue contributing aggressively. Make sure you understand what your pension or retirement account situation looks like. Get a clear picture of how much you will have and how much you need. In your 50s and beyond. As you move through your 50s and toward retirement, the focus shifts from growth to preservation and income. You want to protect what you have built while still generating enough growth to maintain your purchasing power throughout a retirement that could last 20 or 30 years. This is also the stage where working with a qualified financial advisor might be especially valuable. Retirement planning, tax strategies, drawing down investments in the most efficient way, all of these decisions have significant consequences, and professional guidance can be very worthwhile.
Do you need a financial advisor? This is a question a lot of people ask, and the honest answer is that it depends. For many people just starting out, the basics of investing are well within reach through self-directed research and low-cost index fund investing. You do not necessarily need someone to hold your hand through investing €200 a month into a global index fund. But as your financial situation gets more complex, a good financial advisor can be genuinely valuable. Tax planning, estate planning, optimizing retirement drawdown strategies, navigating complex investment options. These are areas where professional expertise can save you real money and real headaches. If you do decide to work with a financial advisor, look for a fee-only or fee-based advisor rather than one who earns commission on the products they sell you. A commission-based advisor has an inherent conflict of interest. They might recommend products that are good for their income, not necessarily the best for you. In the UK, financial advisors should be registered with the Financial Conduct Authority. In the US, look for a certified financial planner or CFP who operates as a fiduciary, meaning they are legally required to act in your best interest. We have covered a lot of ground, but there is one more thing we need to talk about because in many ways it is the most important. The psychology of investing. The truth is, investing is not hard intellectually. The concepts are not rocket science. The hard part is the emotional side. Making good financial decisions when markets are crashing, when everyone around you is panicking, when the news is full of doom and gloom. Here are some psychological traps that every investor needs to watch out for. FOMO, fear of missing out. When an investment is rising rapidly, everyone seems to be talking about it. Bitcoin hitting new highs, a stock that has tripled in 6 months, a friend who made a fortune. The fear of missing out can push investors to buy into something at the peak right before it crashes. The antidote is having a clear, predefined investment plan and sticking to it. You do not need to chase every hot trend. Your boring, diversified index fund portfolio will serve you better in the long run. Loss aversion. Human psychology research shows that we feel the pain of losses about twice as intensely as we feel the pleasure of equivalent gains. This means that when markets fall, the emotional impulse to sell and stop the pain is very powerful. Understanding this about yourself is the first step to managing it. The second step is automating your investments so you're not making emotional decisions every month. Overconfidence. After a few good investment decisions, it's easy to start believing you have a special ability to predict the market. You do not. Nobody does, consistently. The market is extraordinarily complex and humbles even the smartest investors. Stay humble, stick to your plan, trust the process. Herd mentality. When everyone is buying, it feels safe to buy. When everyone is selling, it feels dangerous to hold. But often, the best investment decisions run counter to the herd. Great investors buy when others are panicking and sell when others are euphoric. You do not need to be a contrarian for the sake of it, but learn to tune out the crowd and trust your long-term strategy. The single most important thing you can do psychologically as an investor is to stop checking your portfolio every day. Seriously,
monthly. Log in once a month or even once a quarter. You do not need to know what your portfolio is worth on a Tuesday afternoon. Watching every small fluctuation will drive you crazy and make you more likely to make bad decisions. Invest. Set up automation. Step back. Trust the process. Review periodically. Adjust as needed. That's it.
The world of investing is changing fast. Technology is making investing more accessible than ever before. Fractional shares mean you can now buy a slice of an Amazon share for just $5 instead of needing hundreds of dollars for a full share. Robo-advisors use algorithms to manage your portfolio automatically based on your goals and risk tolerance. Environmental, social, and governance investing, known as ESG, is also growing rapidly. More and more investors, especially younger ones, want their money to reflect their values. They want to invest in companies that care about the planet, treat their workers well, and operate with integrity. ESG funds and sustainable investment options are now widely available. Artificial intelligence is beginning to play a role in investment analysis and portfolio management. New markets, new asset classes, and new ways of investing are constantly emerging. But here is what will not change: the core principles of good investing. Start early, diversify, keep costs low, think long-term, stay calm in volatility. These principles have worked for decades, and they will continue to work regardless of what the financial landscape looks like.
All right, we have covered an enormous amount of ground together today. Let us bring it all home. Investing is not something reserved for the wealthy or the financially sophisticated. It is a tool that is available to almost anyone, and it is one of the most powerful things you can do for your future self. You now understand that investing means putting your money to work so it grows over time. You understand the magic of compound growth and why time is your greatest ally. You know the main types of investments, from stocks and bonds to index funds and real estate. You understand the relationship between risk and return. You have a step-by-step framework for getting started, and you know the common mistakes to avoid. More than anything, I hope you have come away from this video with one simple but profound realization. You do not need to be perfect. You do not need to start with a lot of money. You do not need to understand every detail before you begin. You just need to start. Open that investment account. Set up that monthly contribution, even if it is small, because small, consistent action, taken early and sustained over time, is how ordinary people build extraordinary financial lives. Your future self will thank you. If you found this video helpful, please like it and share it with someone who needs to hear this message. Leave a comment below telling me where you are on your investing journey. Are you just starting out? Already investing? Thinking about it? I read every single comment, and I love hearing from you. And subscribe if you have not already, because we've got a lot more content coming that will help you understand money, grow your wealth, and build the financial future you deserve. Until next time, stay curious, stay consistent, and keep planting those seeds.